Hello, this is Robbie Cannon, President and CEO of Horizon Investments. You're joining us for our second quarter review and outlook. First and foremost, I want to thank you, coast to coast, as we've been talking to advisors, just the tremendous support, and not only in terms of products, but also trust. And I just want you to know that from our standpoint, one of our values is gratefulness, and we really are grateful, not only for the business, but for the trust that you place in us. Joining me today, I've got two individuals from our portfolio management team. First, one of our newest hires, our global macro strategist, with a lot of deep currency experience, Mr. Zach Hill, as well as our head of portfolio management, Mr. Mike Dickson. So thank you very much for joining us, gentlemen. Here's what happened in the quarter. I'm going to go through five issues. We'll talk about them, and stay tuned. We are going to make this more practical as it relates to how our strategies were able to navigate the second quarter. First and foremost, we're going to have to talk about global growth. We'll talk about health in general, especially as it relates to tweets that came out of the presidential phone in May. We'll talk about that. We'll also talk about central bank. Real interesting around interest rates. I mean, you see yields collapse there. That's more of a conversation around the 10-year going to 2 and under 2. But central bank policy really has pivoted quite substantially in the last 6 to 9 months. We'll talk about that, and certainly earnings growth as we go into earnings season. As you look to the right here, you're just looking at asset classes in terms of return. Nothing that you don't already know. One thing I want to point out, and it was a strong quarter, specifically in June, quite stark contrast between April, May, and June. But you don't typically have the Barclays Ag Bond Index returning as high as the equity markets. This is one of those quarters where it did, and we'll talk about why in a second. First, to Zach Hill, a lot of conversation around recession. It's been negative pretty much in the press for some time now, this conversation that the U.S. is slowing down really since third quarter of last year. We're looking at PMIs here. Help me with this, because this also looks negative.
Well, absolutely. Thank you, Robbie. So this is a kind of an overlook of global growth, and these are for various sectors of the economy. The blue line is going to be manufacturing. You've heard a lot of stuff about that in the news. Pretty much all of it has been negative around tensions with trade, uncertainty, and lack of business confidence. However, if you look at the green line, which is the service sector of the economy, more of the consumer-facing side, that has been quite positive. It's been very resilient, and at least in a place like the U.S., where the consumer makes up roughly 70% of the economy, everything seems to be going extraordinarily well. Consumer confidence is at 20-year highs, and there's no real signs that we can see that weakness in the manufacturing sector caused by some trade overhangs is bleeding into the bigger part of the economy.
And it seems like, Zach, this would be pretty normal in regards to a conversation around tariffs, that we would see this kind of movement from manufacturing and this kind of disparity from the consumer.
Exactly right. We are very vigilantly watching for any kind of bleed over into the consumer, but frankly, we just have not seen it.
So we have negative conversations around the U.S. economy. We're not seeing it in the numbers, but here's the leading indicators. And here's what's interesting to me is while that chart kind of dictated this idea that the consumer is healthy, this chart doesn't look healthy at all.
Oh, I disagree completely. This is a measure of future-looking economic indicators, and they generally precede increases in growth. And what you can see here is a couple things. One is these tend to move in cycles. So you can see there's clearly a cyclical nature to growth in the economy. And two, you can see that the orange line, which is the Chinese leading indicators, tend to lead the rest of the indicators on this graph, the green and the blue, which represent the US and Europe. And so what you're seeing here actually is a turning up in leading indicators in China, and we think that's quite a bullish phenomenon for global growth more generally.
So when we talk about, or we at least hear in the financial press about a recession, kind of overblown, but when we talk about China, or we hear about China, that's typically negative as well, but maybe not from an economic standpoint.
No, not exactly. They've changed in terms of what China means to the global economy. Years ago it was just a place where everything was manufactured and shipped out, and now there's quite a large consumer base there. Their standards of living have increased, and they're a much bigger driver for economic growth than they were in the past. And I think this chart bears it out and shows that things are looking up there, and I think we can expect it to filter through to the rest of the economy.
So we're hearing a lot of negative news, but not necessarily seeing it in the fundamentals, at least in the global trends that we're watching. But something that we need to take into account as we're looking at the macro picture.
Well, certainly, yes, absolutely.
Then, as we talk about the global picture, I think we've got to mention interest rates because one of the more interesting facts is this idea that we're tightening in the third quarter of last year. And there's a lot of uncertainty around what Chairman Powell said, Zach. I mean, he kind of confused the markets and said, we're not even close to stopping. And now all of a sudden we're talking about rate cuts.
Yeah, it's been a wild 6 or 9 months for the Federal Reserve. As you alluded to back in October, Chairman Powell was talking about hiking interest rates, and that's what this chart shows here, represented by the green bars, that the market was expecting future hikes from the Fed. And you can see there was a pretty sharp inflection right around the start of the year to start expecting interest rate cuts, but really it's accelerated over the last two or 3 months. And so what you have from this chart is expectations that the Fed is going to lower interest rates, and that, all else equal, is going to be stimulative for the economy.
So good for price action in regards to U.S. equities. But when I look at the previous chart and look at those PMIs and they're trending down, certainly now we've got a tailwind. So not only do we have kind of a forward-looking measure in terms of this move in the Chinese economy, but now a tailwind in terms of interest rates?
Exactly right. They'll be providing some insurance cuts. We expect them to provide some insurance cuts, and that should be supportive for growth going forward.
So recession, not even in the cards for you?
No, not at the moment.
So as we transition to you, Mr. Dickson, we're going to talk about the fundamentals in regards to the markets as it relates to earnings, as it relates to companies, really do bottom up in terms of the markets. But I first want, I haven't seen as stark of a quarter as the second quarter in quite some time. I mean, between April, May, and June, quite different in terms of experience.
Yeah, and it really reminds me of sequence of return risk, Robbie. I mean, let's look where we are year to date. It's a really strong year for both stocks and bonds. It's crazy to think that May was actually one of the worst months, in the past 10 years.
So when we talk to advisors, whether you got in the 1st of May or 1st of April or the beginning of June, your path is going to look pretty different.
Yeah, that's exactly right. June saw a complete reversal of what happened in May and a complete rebound, right? So if you started in May, you had a much different sequence than somebody that started in June. And that's that sequence of return risk that folks really have to deal with.
Well, when you're talking about sequence of return risk, just to break it down, you're just talking about that everybody's path is different. And so I know you're a bit of a statistician, and so stats don't really play out over a day or a month in the market. You really do need how much should we look to in terms of a path before the stats start to bear themselves out?
Yeah, it is really important particularly when we're talking about product design and product objectives, that the products are typically designed to deliver expectations over really a full market cycle. We're certainly not going to see that over any given month or any given quarter. We're going to need years of a full market cycle for a lot of these more secular dynamics to play out before these expectations can really be realized.
It's just really challenging, obviously. I mean, I think about my mom or just the average client, because when they get in and they hit a April or May, it just is confusing. I mean, as that's your first experience to the market versus a June experience or a January 1 of 17 experience. The experiences really make an individual believe a strategy or a certain vehicle is working or not working.
Yeah, that's right, Robbie. And it certainly all comes back to our real philosophy here at Horizon. That's goals based, right? And being able to stick to the objective and stick to the strategy as it relates to achieving these objectives, which can be much longer in duration than any given month or any given quarter.
So we had a lot of good conversation between Zach and myself about this idea of recession and really the macro trends that were actually showing us something quite different from this idea of recession in the financial press. But what do the fundamentals say up underneath it?
Yeah, so as we turn our attention, from that broad global macro view and more to the micro data, of course, it makes sense to take a look at stock market earnings growth. And so that's exactly what we're going to look at on this slide and spend a few minutes on, both from a forward-looking perspective and a backward-looking perspective. So first up, let's talk about the chart here that shows earnings estimates in the U.S. kind of over time. And what you should see is a very nice positive upward trend that actually looks like it's stalled a little more recently for the past 8 or 9 months. And what we think that this does to the expectations of future performance is, since growth is stalled, that makes growth somewhat scarce, right? And if something is scarce, it should be and generally in higher demand, and that should really help push prices higher, right? And so what we think that means is that regional economies and stocks that can deliver on growth should actually command higher prices, and that's exactly what we've seen. If we take a look at the table, where's the growth coming from? It's coming from the U.S., right? We see in the top green portion of the table there, almost across all cap ranges and styles in the U.S., you see very strong positive growth, whereas internationally, you don't quite see the same story. And so, in a lot of our allocation portfolios, of course, we've been very overweight the U.S. markets because of the U.S. market's ability really to deliver on this growth. And then because of going back to these forward-looking estimates, because of the fact that growth is very much in demand currently.
So when I look at this, and I totally get the stall, you see it there in the latter part of 18, you see it in 19, and then I think about the PMI from Zach, I think about the trends from Zach, and the conversation around interest rates. It seems like there's a lot of evidence now for rate cuts. So, this is just telling me another reason why maybe the economy needs an insurance cut.
Yeah, sure. And this growth story is just part of the picture, right? If we look at as we head into earnings season, right, next week, I think it makes a lot of sense to not just look at growth, but look at expectations around that growth. And so as we look towards this chart on the screen here about earnings expectations, what we actually observe is that analysts have been downgrading aggressively earnings on stocks more recently. And right off the top, you might think, well, that doesn't sound like a very good data point. But actually, we think it is a good data point. And the reason we think that is because heading into this earnings season, Robbie, the bar is actually quite low. And as evidenced by the data that you and Zach have discussed, we feel pretty strongly that global growth is going to pick up, and this really might be the catalyst, I think, to drive that for us.
Red is never good except in this slide.
Well, it's all about expectations, right? And the market is pricing off of expectations, and so I think that this is certainly a good sign. It gives us the ability to identify an opportunity, and I think it also, the opportunity we see here is that I think analysts have gotten a little too pessimistic heading into earnings season.
Well, it does seem like it's pretty easy to discern why the financial press has such negative viewpoints out there, is because there is negative news here, but for price action and for investors, it's actually positive because you're looking forward. You're not looking back and going, what happened? You're looking forward into what could happen as a result of this. And so interest rate cuts, earning expectations with a low bar, that typically bodes well for investors.
Yeah, I definitely agree there. And, the big story here, you said it again, interest rate cuts, right? I mean, the Fed currently is being very accommodated. They're being very nice, right? They're playing nice, and we've got earnings expectations set rather low. So we think that makes for a high likelihood that earnings expectations will be exceeded, and we have an accommodative Fed that should help support that global growth story as well.
So as we talk about earnings, valuations, the stock market isn't an asset class in isolation. So we do have to look across the board at what other things you could invest in.
Yeah, exactly. And I think a really clean way to do that is just to compare stocks versus bonds, a very common comparison out there. And that's exactly what we show on this chart. We're comparing earnings yields for S&P 500 stocks versus yields that you can get for U.S. bonds. Red means that stocks are expensive relative to bonds, and green means stocks are cheap relative to bonds. And while yields are very, very low right now, what that means is we sit very much in the green territory. And that means that stocks are actually really cheap relative to bonds. Our take on that, Robbie, is that there's a lot of money that's actually parked in bonds right now that we think could rotate into stocks and help push stocks a lot higher from here.
Probably parked not only in bonds, but also in cash and money markets, just as it relates to the volatility that we had from the fourth quarter and the first quarter, and certainly some of the uncertainty that we saw in April and May.
Exactly. There's a lot of money on the sidelines that can really help take us higher, certainly as it relates to what we believe is an improving global backdrop for growth in equities.
When we talk about retirement income, and you kind of champion that strategy for us, certainly that we have had this stretch for yield for some time. So not only are people looking for returns in terms of equities, but also fixed income. And here you have interest rates really dipping below 2. Interest rates are negative. Real rates are negative well across Europe.
Yeah, that's right. The big number chart of the week that we put out, I think we had one a couple weeks ago that said, what was it, Zach? Was it $13 trillion?
$13 trillion in negative yielding debt is currently outstanding.
Yeah, I mean, that's just a crazy number. That's $13 trillion of people actually you putting money in the bank and effectively paying for it, right? It's a pretty crazy number. But yeah, Robbie, when you talk about seeking income, turning, I guess, the discussion a little more towards the fixed income markets, there's really, two broad risks that are rewarded there. One of them is duration risk, and one of them is credit risk. So first up, let's talk about this chart on the screen here as it relates to duration risk. And here we're just comparing longer-term U.S. bonds, 10 years in maturity, to shorter-term U.S. bonds that are 2-year in maturity. And what you see is yields and this yield spread drastically falling. And so what this means is that the premium that you get from taking on that duration risk just really isn't there. And that certainly has us a little more bullish on short-term rates than we would be on longer-term rates. But more generally, since we're certainly constructive on the underlying fundamentals right now, we're pretty bullish on credit markets as well, because as you can see in the table in the top right, with high yield debt, we can still get 370 basis points or more in return from high yield bonds versus U.S. Treasuries, which is actually a pretty good return, Robbie.
Well, it's amazing to me. With with the negative news in the financial press, that there's actually a lot of reason to be positive, and a lot of reason to be looking for opportunity for investors and for individuals seeking to achieve their goals with portfolios.
Yeah, and I'll say one more thing about this income picture as it relates to opportunities. Let's take emerging market debt. We can get about 300 basis points more, 3% more per year than a comparable U.S. Treasury in emerging market debt, and that's not high yield. That's investment grade paper there. So as far as seeking income goes, we don't think longer duration is the answer right now. That premium is just not looking good. And instead we'll favor more of the short duration and credit markets for that.
So, taking all this into account, one thing I would ask both of you is, if there was one risk that you were worried about, and it may be the president's phone, and I'm okay with that, what would it be? So as you look at the whole backdrop and you look at the macro trends, Zach, you look at the valuations, you look at interest rates, the central bank, what would be that one risk from a global macro standpoint that you'd worry about?
I think from a global macro standpoint, the risk, and we flagged it a little bit earlier, would be just a sustained weakness in the consumer sector from the manufacturing part of the economy. We have not seen that, and as you said, and we talked about extensively, the Fed is moving to act to stem any weakness there. But if things do continue down this path, we could see potentially some weakness in the consumer side of the economy, which has been the big driver thus far.
So Mike, your risk, and Zach already took consumer, so you can't take that one. Which one would you take?
Yeah, I think I got to go back to the earnings growth slide. And while we've seen that earnings growth has stalled more recently, right, what did we also say? We said expectations heading into earnings season are pretty low, right? So we think that low bar is in place. I think it'll be a pretty negative signal to the market if we get through this earnings season and that line starts to trend down. Because I guess to piggyback on what Zach said, he's concerned about the consumer. If the consumer isn't healthy, and we also don't see growth from the micro side of things and stock earnings, that's going to be a problem.
I think the one surprise to me in this conversation is neither of you mentioned China, which I think is interesting. But you also said that, and you weighted your opinions towards the U.S. But key takeaways, when you look across the board, spoiler alert, look at the bottom, it's risk on. So the conversation is all around stocks and credit as it relates to, cash and bonds. And so from our standpoint, we look across, we look at not only the U.S. economy, but also the second largest economy in China. And things are, they're not heated up necessarily, but they're definitely, there's a stability there, whether it's the consumer here in the U.S. or whether it's policy in China. And then in regards to yields, credit stable. And so from our standpoint, obviously there's risks. Zach mentioned some, Mike mentioned another. We still think that this is a good and persistent market to invest in terms of being more on the equity side. Obviously, as you have more conservative investors, we'll look at them in terms of more credit.
Yeah, certainly, Robbie. And I would echo that, just not just credit, but on the short duration side of things, right? I mean, bonds just really don't look, sovereign bonds really just don't look that attractive at this point.
So let's talk a little bit more practically now about not only for those of you just joining us, we do split up the wealth curve into 3 phases: accumulation, preservation, distribution. We call it gain, protect, spend. We've got product sets in each of those verticals. But first and foremost, Mike, gains our allocation strategy. It's our most broad allocation strategy. And so what's the most important thing that our advisors need to take away from this?
Well, first, Robbie, I just want to mention these big numbers, right? What are these? And this is just the first 6 months of the year, stacking up semi-annual returns for the S&P 500 and broad investment grade bonds, 17% and 6%. What we see in the charts is that these are some of the best 6 months in the last 10 years. We've had a really stellar start to the year. And, in the game portfolios, being fully invested certainly has added a lot of value. And when we look inside of some of those investments, some of the best performers that we had is, as we've mentioned, I think already, are overweight to domestic markets and quality type growth factors. Some of these quality growth factors are going to be things like very strong, stable balance sheets and fundamentals, both on the top and bottom line. Stocks that have really been trending well and generally are defensive in nature in their price action. That added a lot of value in our portfolio, certainly in this quarter. We've had some detractors as well, primarily some dividend focused and China exposure, but we are constructive on that moving forward, Robbie.
Yeah, I mean, we talked a little bit about China earlier. I would just say that China is one of those weird issues. When you look at it from a quarter standpoint, it's really hard to kind of get a gauge of that from an investment standpoint, because you have May with President Trump's tweet sending a lot of risk in the emerging markets and in China positions specifically, whereas in June and July, it's actually picked up. And so it's really hard to kind of cordon off the quarter and say that China was a bad trade, because you got to look more broadly.
Yeah, and I want to go back to something you said just a few minutes ago, Robbie. You were actually surprised that neither Zach or I mentioned China as a particular major risk right now. And I think it's exactly because of what you just said. We've already seen a lot of that risk play out. The market is almost kind of numb to it, right? So in fact, at this point, China looks very attractive moving forward, as I don't think that the Trump Twitter feed is going to have quite the impact as it relates to China moving forward as it did 6 months ago.
So more domestic focused than international, and certainly we're actually playing the 2 largest economies in terms of the U.S. and China, specifically with fixed income here. Actually, the quarter was really good for actually most fixed income managers.
Yeah, it certainly was, Robbie, and we definitely had the credit, being one of the biggest contributors to our performance this quarter. And on the shorter duration side of things, that did not help throughout Q2, but we think that will help moving forward as where rates are currently, that duration premium just isn't there.
So as we transition from gain portfolios to protect portfolios, when we look at the second quarter, you do have the tale of two cities. No surprise, especially in the middle of it, you had some volatility around the president's tweet.
Yeah, sure. And I think that within our protect strategies, there's really kind of two major process adaptations that make these strategies different than our game portfolios. I think most importantly, right, it's the main measure of risk that we're focused on, and that's loss, right? And so one of the process adaptations in our protect series is we do have a slight defensive bias. And so this relates directly to this big number we have on the screen here at 8.3%. What is that? Well, that's the one-year spread between defensive stocks in the U.S. and the S&P 500. In other words, those more defensive focused allocations have been outperforming the S&P 500 a little over 8% over the past 1 year. I mean, that is a big number considering that the beta on those stocks is significantly less than 1.
And when we talk about the portfolio management, specifically in regards to some strategies that may de-risk for us, we would expect some drag in a quarter like this where you have some volatility kind of mid-quarter, and then you would expect them to reinvest latter half of the quarter in June as the market strengthens.
Yeah, exactly. I think one of the other major differences between as far as process adaptations go with gain and protect is that in protect, we may not be fully invested at all times. And so we saw some of the May volatility cause a little bit of activity as it relates to our protect series and de-risking type of events. But we saw complete reinvestment activities during the month of June. And most importantly, Robbie, we saw those protect portfolios capture most of those gains in June. And where we sit ending the quarter is certainly fully allocated to the markets.
We've seen a lot of that in those de-risking portfolios. I mean, you talk about the fourth quarter, you de-risk significantly based off what Chairman Powell said in October. And then, as the market came back, you missed some of that upward momentum that the market had in January. And then you had some of the risk associated with the Chinese tariffs in May. This is one of those market times in the last 6-9 months when sequence really matters.
Yeah, I couldn't agree more, Robbie. I mean, sequence matters so much as you have the Q4 of 18, a complete reversal in Q1 of 19, right? And then on a smaller scale, we also saw that in May and June, right? So depending on exactly which time you got in the market, your experience could be a lot different than somebody that started just a month or two later.
It's really hard because advisors, when I talk to them, one of the questions that's on everybody's mind as they come in is this the right time to invest? And that's a really challenging question, especially this quarter kind of drew it out, is that it's really challenging to answer that pre-tweet and post-tweet, and now as we sit in July. So it's interesting as the different time periods actually affect the movement and the different strategies. So as we kind of round out here, we're in the distribution phase. We're talking about spend. Remember, spend for us is about longevity. It's about, what's the longest I can spend these assets without running out? And so we actually look at this a little differently, Mike. And I know, again, you champion this cause.
Yeah, exactly. In the spend portfolios, we're focused on minimizing longevity risk. And of course, many of you are familiar with our story here and how we manage these portfolios, but our allocations typically favor stocks over bonds, really to take advantage of that greater capital appreciation offered by stocks. And I think this brings me right to this big number of 10.8%. What is this? This is we've got the annualized return over the last 3 years of stocks versus bonds. Stocks have outpaced bonds, global stocks, that is 10.8% over the last 3 years on average. That is a big number, and it's that type of capital appreciation and gains that are going to help minimize longevity risk in the distribution phase, for sure. But when we look at attribution as well, domestic markets added a lot of value here in the spend portfolios, and Another kind of process adaptation in the spend portfolios is on the equity side, we tend to also have somewhat of a defensive bias in these portfolios, and that also added a lot of value as those stocks have done very well.
Well, as it relates to gain, protect, spend, whatever portfolios you're taking advantage of, again, I want to thank you not only for the business, but also for the trust. For me, Robbie Cannon, this is Zach Hill and Mike Dickson. We wish you a great quarter, and we look forward to seeing you next quarter. Remember, if you want to get in touch with us, there's a number of ways to do that. Call our sales desk. Certainly, you can see us on our social media. Again, for me, I want to thank you for joining us.